Welcome to Bendigo Bank's monthly market update with our latest forecasts and thoughts on global markets and the domestic economy. For October, we'll have a look at the latest trends on inflation, how labour markets are progressing and their implications for interest rates, and financial markets, including fresh record highs for stocks. As universally expected, the RBA kept official rates on hold this week, consistent with this year's pace of quarterly cuts. However, their messaging, while cautious, increasingly points to this easing cycle nearing completion. Our forecasts are unchanged for a shallow RBA easing cycle back to a more neutral rate around 3.25%. But the timing of the next cut expected in November is under question, especially after the RBA press conference yesterday. The recent monthly inflation indicator for August did show the consumer price index back up at 3%, and some key categories have risen sharply. But the RBA's preferred measure of core inflation was only 2.6%, so a cut-day cut on November the 4th remains the favourite. The key event ahead to verify this timing will be the full quarterly CPI numbers out on October 29th. So barring a significant jump in core inflation, the easing cycle should continue. But it's a complex environment, and Michelle Bullock did warn in her press conference that inflation may be persistent, a reminder that the cash rate is unlikely to fall below neutral. Looking beyond interest rates to the state of our economy more broadly, economic growth is running ahead of RBA forecasts thanks to a rebound in household spending, and labour markets remain relatively solid with the unemployment rate still around 4.25%. Trend data shows conditions for employment are slowly easing, but the RBA still expect demand for labour to remain intact, so the unemployment rate not to rise at all from here. Our forecasts are less optimistic on this front, so upcoming jobs data, including the next release on October 16th, will be influential for rates. Meanwhile, the global economy remains as uncertain as ever, although not all uncertainty delivers bad outcomes. Tariffs remain problematic, but thus far, more extreme scenarios to the downside haven't emerged, as initially feared. Stock markets have again set fresh record highs in a wide range of locations, still looking through short-term impacts of tariffs and geopolitical tensions to the medium-term upswing promised by AI and other emerging technologies. Stocks may well be right to factor in this upside, but its implications for FX and bond markets appears less decisive. Our forecasts continue to assume a weaker US dollar ahead as the Federal Reserve cuts rates despite rising US inflation, which may also be challenging for bonds. But for now, markets are marching on. And that's the market update from Bendigo Bank.